on the breakout, gold's going to make a new all-time highs.
Gold-backed ETFs seen inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin. All right, welcome to this week's episode of Live from the Vault. My name is Shane Moran, and I will be your host for this exciting episode. Now, we've asked our community, our global community, to go ahead and comment on who they would like to see interviewed regarding the physical gold and silver markets. And we're listening, and we've got a blockbuster interview for you today. You're absolutely going to love it. Now, just before we go to the interview, I want to go over to Talking Gold with Andy Maguire. And look, Andy, it seems like with regard to the gold and silver markets, these past 2 weeks can seem like a couple months. There's so much going on. Maybe we can start the episode off by picking up the thread of last episode as we continue. So over to you, Andy.
Absolutely, my friend. And let's start by taking a look at the extremely aggressive end of quarter official action, which resulted in a major overshoot of really what can be only described as physical support levels. Now, obviously, that had a lot of people scratching their heads. And it was so counterintuitive in nature. And it was really, although we evidenced the paper to physical dislocation in the wholesale market, we noticed that first. But really, and we're talking about this end of quarter session, which since the last 2 weeks that we've done our episode, of course. And what was really evident was the unprecedented deep backwardations as we ended the quarter. And the April gold futures contract, if you remember, the gold futures contract was expiring at the end of March. And then we would then perhaps expect maybe a little backwardation at that point. But what we witnessed was this enormous, unprecedented degree where we saw the new June contract roll onto the board. And guess what? There was a massive backwardation right away into the June contract. Now that should not be happening. And really what this is telegraphing, what it telegraphed to us was that the paper market selling was grossly overdone. And in fact, what an opportunity, in fact, it was telling us. And obviously overdone versus the physical market. And it was no surprise, of course, to see the market making insiders taking the long side of every tricked in sell order. And you get to see that in some small degree in the COT report. We discussed that before, how that delayed report reveals something, but not everything. Now, what we're really focused on now, and obviously this is the end of the quarter, but what we're really focusing on now is the 90-day Basel III window. And we're talking about 90 days till the June the 28th. And it'll be the last date for banks to unwind very large unallocated gold positions before this 85% haircut makes it far too expensive for them to engage in gold lending or hypothecation. Now, in anticipation of this new regulation, banks do not want to be short gold. Of course they don't, especially as we're talking about the massive amount of unallocated short gold positions. Now, these are unbacked. Now, aside from what we're seeing in the wholesale markets, which gives us quite a degree of visibility, this is actually also partly evidenced in the futures structure. Now, since the 80,000 contract peak in gold open interest, and that was in January 2020, and what we've done is we've witnessed these insiders exiting their short positions and positioning long into a reduction of 35,000 lots of open interest. And that obviously means a lot to traders when you see that amount of open interest reduce. Now, notably, really, this is very important. Open interest has now fallen to the lowest level since May 2019. And just to remember, gold was trading well over $400 lower at around the 1270s at that time. So we're back to that kind of level of open interest. So that's got to be a red flag if you're a short, because you're now dealing with far less open interest that you can possibly play games with. Now, as we recently warned, and we warned this in our last 2 episodes, the very short-term effect of the Bank of International Settlements and these related insiders, when they buy back unallocated gold positions to square up these least swapped gold positions, in other words, what we're saying is the unwinding of these massive unallocated gold positions, what it initially involves, and we did warn about this, is that when you sell these long foreign exchange fractional gold positions to buy back and square up the dollar side of the foreign exchange currency cross, on the face of it, this action looks bearish. But it's more akin to pulling off a band-aid. It's better to do it fast. And this is exactly what we've been witnessing. And it's not a surprise. And this is the unallocated squaring, and this accelerated into the end of the first quarter March trading. But what we're saying, though, is although this effect has been readily exploited, obviously, by the market-making insiders, because they have control of the market, and they're doing their part by pulling the bids and assisting officials in rinsing out margined longs at the very obvious moving averages. And we've talked about this multiple times, how you want to play. If you hold the position concentration and you reach a moving average, you pull some bids, you're a market maker, you can actually without going short, you can actually create a dip. And this very large unwind of unallocated open interest is actually rapidly improving the paper to physical structure, as the window to actually complete this is fast closing, as we say, in less than 90 days from now. So ultimately, there are trillions of dollars of over-the-counter market liquidity to tap into, but given the accepted well over 100 to 1 leverage ratio, and remember, this is not a number we've pulled out of the air. That is accepted by industry apologists, backed up by them, and it's also backed up in the 2010 Reserve Bank of India report that this selling, this is the 100 to 1 leverage ratio, which they said somewhere between 92 and 100. This selling initially has a negative effect on price, but under the covers, what it's doing is removing the short fuel that really enables physical market hypothecations. And as we know, gold leasing is the principal tool employed to short gold. So reducing this activity makes it much more difficult to short gold, and it's therefore bullish. Now, the BIS has swapped and leased hundreds of tons of physical gold, while in reality, not a single ounce, we talked about this multiple times, not a single physical ounce has left their site account for well over 3 years. In fact, longer than that, but at least 3 years. Now, I'm going to refer to GATA's Robert Lambourne. He does an absolutely excellent job of assisting in demystifying this deliberately opaque smoke and mirrors world of the BIS swaps and leases. And as he points out, the February swaps are now estimated at, say, 552 tons. This estimation very much jives with what we would assess in the wholesale market, whereby when you net out legitimate physical flows around the major desks and trading hubs, we're quite certain that none of these hundreds of tons of lease swap bullion ever hits the open market in physical form. So, instead, these leased gold liabilities secretly sit on the books of the too big to fail bullion banks. And with these are the banks, if you remember, and we call them insiders because they know when the selling is going to come through. These guys are privileged to have gold accounts with the Bank of England. And as we've reported in previous episodes, it's unlikely the BIS would further leverage these swaps and almost certainly allocate. What they're doing really is the allocated to unallocated swaps are really just 1-to-1. They're not leveraging it further than that. I think that would be extremely dangerous and very difficult for them to explain. But thereafter, when they lay this out to the bullion banks, there's nothing to stop the bullion banks further leveraging these swaps on their own books. And they do that with impunity, well, because they know that they can be squared. And this simply means that the BIS is one-to-one short allocated gold and long unallocated gold. It's that simple. And look, this view is shared by every physical desk that I've spoken to and we deal with. Notably, as we commenced March trading, these hypothecated positions had grown to historically high levels. And it's just no coincidence that COMEX open interest has grown by 226 tons since the March 2020 EFP blow-up. So you can see what's happened in these leases have actually increased by 226 tons since the March blow-up. Now, why? And if you recall, this unallocated gold expansion commenced into a period when there was, if you remember this, closed Swiss refineries, transportation, airlines were frozen. Yet, if you remember, we supposedly evidenced hundreds of tons of COMEX, GLD, ETF inflows, iShare inflows, hundreds of tons combined in this exact same period when there was no physical around. And it should not be forgotten that following this EFP blow-up, absolutely no size was available in the wholesale market at any price. And no matter what the premium was that we would offer, there was nothing available. It was simply frozen. The refineries were shut. And in reality, so really what we're saying is these inflows were absolutely impossible to fulfill into a frozen wholesale bullion market, which basically clearly telegraphs these were official swaps. There is no one else that could have done this. And that's where this bullion, supposed bullion, unallocated bullion, came from. And these resulting liabilities now sit on the books of the too big to fail bullion banks. They don't sit on the BIS's books. And as we've discussed in prior episodes, while it's possible for the BIS to keystroke square unallocated positions sitting on the books of these too big to fail banks, they cannot do so with the rehypothecated positions sitting in the ETFs like GLD, iShares. And we've started to see this unwind, accelerate as the June NSFR deadline approaches. Now, obviously you can go back on episodes and we could drill into the detail, but obviously we just want to keep this moving along to keep the thread consistent. Now, obviously, selling unallocated gold positions to buy physical bullion initially has a lagging effect due to the fact that the sell side is leveraged and the buy side isn't. But with less than 90 days to go, the Basel III window is fast closing, and the effect of selling unallocated gold, and you can include silver in that as well, will be offset by an increasingly influential physical market driven by a globally driven inside and central bank race to allocate. Now, the March BIS sell-off has likely crossed these lines satisfactorily, and we should start to evidence strong physically driven bullish action commencing this second quarter into the end of the second quarter.
Now, Andrew, I remember that a couple weeks, actually for the past couple episodes, you've been reporting on the central bank buying activity. And can you tell us if this is still going on now?
Yes, Shane, it is. And it's stepping up now. Now, we reported this into the March sell-off. And it's no coincidence that we're evidencing central banks openly repatriating and upping physical gold purchases, as well as insiders exiting their net short positions as fast as possible. Now, we've also been reporting massive central bank and sovereign physical demand into last week's final BIS kick at the can. We think that is the final kick at the can, simply because, as we just described, the open interest has now reached levels where we're looking at hundreds of dollars higher and with very, very minimal ability to rinse anymore. Now, into the counterintuitive but I think explainable price action, every single global bullion hub from India, Turkey, Switzerland, Asia has reported very large gold premiums into this sell-off and extremely strong physical demand as central bank size of physical was sought. Now, it's going to be reported by the end of this month of April that actually, you wait for it, that the BIS and the related insiders and the global trading hubs like India and Turkey, which can often trade at a discount but really evidenced premiums last month, and every central bank has officially increased their physical reserves during the end of the quarter smackdown, including the BIS. And it must also be taken into account, though, that a lot of central bank buying is actually bilaterally settled and not reported. So when we look at the physical reports, physical stockpiles underpinning the paper scam are actually dwindling a hell of a lot faster than it might seem. So if we dig just a little deeper, structurally, there was little need for the BIS to close spot gold below 1700 to 1750. And I remember saying that. And it's clear that their agent insiders privileged to have these gold accounts at the Bank of England capitalized on a strong dollar, rising bond yields. Remember, we called it a toxic cocktail. What they did was, again, pull bids, rig prices lower to buy back unallocated positions ahead of the second quarter, which has now commenced. Now, we'll see Basel III and SFR haircuts come into the crosshairs. And then, of course, unallocated gold positions to be bought back or allocated. You watch this start to unfold. And the second quarter into June 28th, really, bottom line, is expected to be increasingly very strong for gold and silver. And why should it not be? And in fact, look, the COT report, this report that is deliberately delayed by 3 days in a picosecond world when the data is available. And in fact, if you remember, it was released this last time on Good Friday, which is a market holiday. Gold and silver were closed. The Globex was closed. The spot markets were closed. The European spot markets were closed. No fixes. And yet they were able to turn up this COT report when clearly the data was available well before it was published on Friday, because nobody was working on Friday. So no government worker was working on Friday. So it just as an illustration, of course, why do we have to wait till Friday when clearly they were able to do it on Thursday? And we know that the data is available on a Tuesday night. So just to reaffirm how this report is so spurious in nature. And it doesn't stop there. When assessing the COT report, it must be borne in mind that current gold open interest, actually these numbers include short hedges related to allocated bullion held legitimately by an increasing number of second-tier banks seeking to comply with Basel III rules. And as we pointed out multiple times, these COT reports are near on useless without balancing it out with the 10 times larger over-the-counter market activity. And the open interest collapse, it really just partly reflects the unwind of unallocated gold positions. And in silver, these reports do not reflect physical and over-the-counter positioning at all. So when reading them, be cautious. So really what we're saying is, look, short-term, the open interest structure of both reports are currently extremely bullish. And that's kind of where I wanted to leave it because we've got some really exciting guests to introduce in a minute. And I think this is going to be a real blast for everyone. A really good friend of mine, Alasdair Macleod.
Well, thank you very much indeed for inviting me on.
Well, you know, it's interesting because I think sometimes I live and breathe gold, silver, and sometimes we have to be aware of the crosses and all these other factors. And I think that's why it's so helpful to have, your view on the wider economy and how things interact. And I think you have such a wide spectrum of financial knowledge, and we will try and cover a wealth of subjects, but with time limited, I'm going to try and look at the crosses that impact the gold and silver markets. And Alasdair, I just provided a bi-weekly gold and silver market update just ahead of this, but it would be very helpful to get your view on the economic drivers really relating to gold. And I guess my first question is relating to debt to GDP running north, I think, 130%. And it's likely the Fed does not want a stronger dollar. And we've had a lot of questions around the underperformance of gold and silver over the last few weeks. And I did have a brief discussion on this with my pal Craig Ferguson recently. And it was all about the persistent dollar strength, rising bond yields, acting as the really primary sell drivers in both gold and silver. And historically, there's been a kind of inverse correlation between bond yields and gold. While history really has proven that a rising dollar is not necessarily bearish for gold. And certainly in times of uncertainty, we can see both the dollar and gold be sought as safe havens. And I sometimes put safe haven with a dollar with an inverted bracket, but obviously gold's a proven risk mitigator. So Alasdair, I'd love your thoughts on that.
Well, I mean, starting with this question of the dollar and strengthen the dollar and all the rest of it. Not many people are around now who have experienced what happened in the 1970s. I mean, we entered that decade, I think, with and please don't tell me if I get this really wrong, but I mean, this is it's approximate. We entered that decade, I think, with US Treasuries yielding around about 6 or 7% and gold at $35, and we finished it with gold having hit 850 and interest rates, US dollar prime rates at that time went up to over 20%. So this sort of myth that rising interest rates is bad for gold is actually not true. And I think a lot of the mistake is people don't understand that gold actually does have an interest rate. It is completely different from the interest rate on a fiat currency. I mean, if you want to borrow gold out, say, a year or something, I mean, you could probably quote me the rates, but I think you're probably looking at a rate of a couple of percent or something like that. Whereas in more normal times, rather than these suppressed interest rate times, at the same time, you would probably see dollar rates for 2 years going out to, say, 5 to 7%, something like that, in more normal times. So I think we can dismiss that concern right from the off. But overall, I think the problem that you and I face is we see markets are totally broken. So there's no logic between what's going on in one side of the market and what's going on in another. And the reason they're totally broken is because the Fed is suppressing interest rates. And it's doing that for two fundamental reasons. The first and more obvious is it has got budget deficits, government budget deficits to finance. And that is a serious task, particularly given this COVID crisis. And the second thing is that the Fed is intent on creating a wealth effect by pushing up financial asset prices. And this is the whole purpose of QE. And now we've got 120 billion a month going into insurance companies and pension funds and similar establishment investment management vehicles, where they're taking out low-yielding US Treasuries and encouraging pension funds, insurance companies and the rest to go and buy more risky financial assets. And so it's hardly surprising that the equity market has become completely divorced from any fundamental reality. And it's hardly surprising that the yields, if you like, in the corporate bond market have become suppressed by the weight of money coming out of lower yielding US Treasuries. So we've got these massive distortions. And it's interesting because the sort of conventional macroeconomic approach is to look at correlations between this, that, and the other thing. But forget it. It's a complete waste of time in these conditions. The only thing you can do is actually stand back and analyze the situation properly. And interestingly, you mentioned debt. I've just released an article looking at debt, and the figures, so far as I can establish them, are that globally debt is $284 trillion equivalent, And that works out at 335% of global GDP. Now, this is obviously a moving target, and you've got all sorts of things that change the numbers, but that's the sort of scale of numbers that we're looking at. And the debt is really in a number of different categories. You've got government debt, obviously, and that's running at about 103% of GDP around the world. And let me just say about government debt, the wrong comparison is actually to think in terms of government debt to GDP. What is far more relevant is government debt to its tax base. And the tax base, of course, is the private sector. And if you go around the world, approximately 40% of GDP is government. Take that out, you've got 60%. So instead of the thing being, sort of around about 100 and something percent, I mean, you can almost double it to get a true figure. That is really what matters. Anyway, that was one section, government. Another is obviously finance, the financial sector. And the thing that's interesting there is that the estimate in that $284 trillion includes around about, I think from memory, it's something like $64 trillion of finance sector debt. Now, I can account, even just in the GSIB banks, the liability side of their balance sheets amounts to 58 trillion. So they're wildly underestimating the amount of debt within the finance sector. So that's a point worth bearing in mind. And then you look at the corporate sector, and that is very concerning. And interestingly, it's the sector which nobody really pays very much attention to. But when you bear in mind that private equity has gone in and bought good companies and turned them round from being companies which repay their debts into leveraged bets so that the private equity firm can strip out high dividends. I mean, basically, they just end up leaving a zombie shell and they walk on and then do the next one. As well as that, of course, we know about all the lobbying efforts that go on in places like Brussels and Washington and, to a lesser extent, London. And these are large corporations who no longer serve customers. What they do is they try and get advantage, preferential government advantage, and also a monopoly out of government. So they also are zombies. And the debt in this corporate sector is absolutely enormous. And the problem for the banks is they're no longer very keen to push working capital into the corporate sector, the non-financial corporate sector, because of all the risks. So this is looking like falling over. And if you look also, as far as the corporate sector is concerned, just have a look at the supply chains. They are in a mess, and they've been in a mess for over a year now. I mean, if you're fortunate enough to have an expensive apartment in Los Angeles, you get the binocs out and have a look and you see all the ships sitting there at anchor. They're going nowhere. And the containers are stuck in completely the wrong place. I mean, people in the industry reckon that it'll probably take towards the end of this year, all being good, that the logistics foul-up will be sorted out. And that's a problem because in America, gross output, which equates to the payments in the supply chain, we're looking at $38 trillion. This is on a GDP of around about 20 trillion, by the way. So you can see it's almost double the final, if you like, the final product, which is really what GDP is. Now, is the Fed going to rescue all this? I mean, the Fed basically has three tasks. And, one of them is to finance the government, which I've already mentioned. The other is to keep the economy going, which is getting impossible. And of course, the third is to keep the bubble going. The problem with the bubble is that now we've got rising interest rates, and rising interest rates are occurring. Why? Because people are making a reassessment of the likely rate of inflation following lockdowns over the rest of this year and into 2022. And quite clearly, there is a supply issue. And this is apart from the supply chains all sort of falling apart. I mean, the fact is that we don't have the industrial capacity anymore to absorb the spending that is likely to be unlocked as a result of the end of COVID. So prices are going to rise at a considerably more rapid rate than that 2% ceiling, which all the central banks work to. And that 2% ceiling, incidentally, is a complete myth. I mean, we know this from other statistics. I mean, particularly in America, you had John Williams at Shadow Stats, and he's been calculating on an unadjusted basis from the way in which it was all done back in 1980. And he's seen price inflation running at anything between 7 and 10% for the majority of the time since the great financial crisis. And the Chatwood Index is another one, which, and you look at their most recent statistics, which unfortunately are out of date because they've stopped collecting them because of COVID. But there you're looking at a similar rate of inflation. In fact, just the wrong side of 10% on average rather than the right side of 10%. So this is actually what's happening to money. So it's only a question of time before people begin to wake up to the fact that this is happening to money, its purchasing power is going down, and at the same time, debt is exploding. So, putting all this together, the burden on the government and government agencies is far too great for any desire, any possibility of reducing the growth of the rate of debt. I mean, we've seen how money supply has taken off. And we've also seen the argument, and this is the fascinating thing, for the first time, even die-hard socialists are turning around saying, you can't raise taxes because you'll screw the economy. Well, what does that do to government spend, to the government deficit? I mean, they're embedded in the whole system now, which basically means that ultimately the currencies will collapse. And in the middle of this, you've got the banking system. I mean, I just look at what's going on in the Eurozone. The major GSIBs there are in a horrendous position. The whole economy is in a horrendous position. If you look at the debt to private sector in Italy, we're looking at 340%. Look at Greece, we're close to 400%. No, it's a bit less than that, probably about 370%. I mean, you're going to find that the pigs and France, because France's debt situation is pretty bad. I mean, France also, roughly, I think just under 40% of France's economy is private sector. In other words, it's dominated by government. So just imagine that tax base with that huge, great government on top of it. Yeah, I mean, the situation there is that those countries are in dire trouble. And who's bearing the cross of all this? The ECB. The ECB has to finance these governments. The ECB is seeing a situation where if they fail, then it's the end of Brussels, it's the end of the euro, the end of the ECB. And you only need to think about this situation just a little bit to see that that is not beyond imagining. So that's a sort of quick overview, if that hasn't scared people.
Alasdair, no, that answers. And in fact, what that sort of suddenly brings to mind in my mind, it was something I was going to actually ask you about this. We've suddenly seen, you talked about Europe just now, and it's something that you'd written a long time ago that caught I remembered it because of the history of it. But the exit of the UK from Europe, it's really only just started to play out. And you'd once suggested that unless a 21st version of the Hanseatic League type trade alliance could be agreed, based on commerce rather than politics, which seems to be not the case, this could perhaps be the slippery slope that would end the euro as a viable currency. And you've just literally nailed that as part of that. That was a very interesting article, by the way.
Well, I think the order of events is we're going to have a crisis in the euro first before Germany will feel freed, if you like, to do the deals that will make it central to the new Hanseatic League. We've also got a problem in this. This is the geopolitical problem, and that is that America would be dead keen to stop it. I mean, we've already got the problem with the Ukraine, where with Nord Stream 2 lines, Russia and Germany are bypassing the Ukraine, which basically means that the the prices that the Ukrainians load onto oil and gas in transit. That's what they want to get out of. They want to get away from that, particularly from Russia's point of view. I mean, from multiple points of view, and also because the Ukrainians are bad payers. So, this sort of thing is already planned. But we're going to see, I think, in the coming months, quite a bit of activity on the Ukrainian front, and a lot of pressure applied to Germany, the EU as a whole as well, to cancel that Nord Stream contract. But I think it's gone too far. And furthermore, the long-term interests of Europe are a lot more bound up with Asia. I mean, this goes back to Halford Mackinder, the world island concept. The world will be ruled effectively between the Volga and the Yangtze. That was what he wrote back in 1904. It's a situation which China and Russia, between them, are exploiting. I mean, the amount of development that they've been putting in with the Silk Roads and all the rest of it is massive. And even now, Zanussi in Italy, it doesn't make its white goods in Italy. No, they're made in China, and they're then transshipped, and it takes less than a fortnight for those goods to arrive in the showrooms in Italy. Mercedes are doing it the other way. They manufacture in Stuttgart. They just put the cars on the train at the Stuttgart terminal, and 10 days later, it's in the showroom in Beijing. This is massive. And the idea that America can persuade Europe to cut off its trading links with the rest of Asia, I'm afraid, is completely wrong. And they're not going to allow it. So I think I can see a schism there. These are very important times because America has dominated the world, as we all know. But if you look at America now, I mean, the GDP of Europe, the EU, is now greater than America. The GDP of China on a purchasing power basis is greater than that of America. America's no longer top dog. Now, okay, she may be top dog militarily, but actually what matters at the end of the day is what sort of economy do you have to support all the costs of your defence and everything else that's required, and to give you power around the world. I mean, we look at Germany. I mean, there's a very good example. Both Germany and Japan, who lost the Second World War and were completely destroyed. By having a savings-driven economy, not only have they recovered, but they have become the strongest two economies on earth before China got the message. And this is very, very important to understand. America hasn't got that message. We in Britain didn't get that message. We've been basically spend, not save. And that is the principal weakness, and that is why Mackinder was right. You'll find that the world island, which also includes the whole of Africa, incidentally, on his analysis, is where the power really is going to lie in the future.
It's so interesting. I mean, this is the thing. This is why it's so interesting to talk about these things, because these have massive implications for gold as well. And I mean, you just mentioned the Russian and Chinese really geopolitical partnership. And I mean, look, these are the two leading nations, of course, that behind the Shanghai Cooperation Organization. And although the SCO now, that actually includes India, Pakistan, and a whole bunch of other members. So now, considering this is often forgotten, the SCO comprises of probably 3 billion Euro-Asians, and that's about half the global world's population. And I mean, so you just mentioned, I think you just really alluded to this, that the greatest challenge for the SCO is going to be this American economic power and technological supremacy being challenged. And especially as we've got Russia and China clearly determined to ditch the dollar and increase gold reserves. We've got, I mean, what are you seeing in as far as that's concerned?
Well, that is actually probably one of the most important points in the whole world, because America has promoted her dollar basically by demoting gold. And yet we have the Chinese and Russians who have taken control of physical markets. I mean, particularly China. If you want any physical gold, I mean, it's all locked up in China. Whether you get an export license, of course, is another thing. But what it means, and they've also got a lot of hidden reserves. I mean, not only has China become the largest miner, not only has she become the largest refiner of her own gold, etc., but I reckon, and I had some confirmation on this from sort of quasi-intelligent sources, that China has stored something like 20,000 tons of gold, physical gold, in various accounts. They don't appear in the central bank's account, but we're looking at the Communist Party accounts, the army accounts, the Young Communist Party's accounts, and so on. It's sort of spread around. I suspect that Russia is a similar situation. My guess is that apart from her monetary gold on the central bank's balance sheet, there's probably a further 8,000 to 10,000 tons there, not made visible. But there's a problem with this, because if China and Russia decide as partners, we're going to come out and we're going to say exactly how much gold we've got, or we're going to load up our monetary gold so that, let's say, the Bank of China, has 10,000 tons, and the Russian central bank has, sort of 4,000 tons or something like that. The risk is that it starts to destabilize the dollar. And the one thing that has been consistent in the actions of the Chinese, less so the Russians, but the Chinese, is they do not want to be associated with destabilizing monetary conditions in the West. They would rather have an evolutionary approach where their currency begins to be adopted more and more for trade, rather than destroy the dollar. In a sense, it's against her interest to destroy the dollar, because she's got a hell of a lot of them. But, I think one thing that was very interesting was, if we go back to last March 2020, on the 20th of March, which was a Friday, the Fed cut its funds rate down from 1.5% to 0. On the Monday, it then announced 120 billion a month QE and various other measures to suppress the yields of corporate bonds. Now, more or less from that moment, China changed her attitude towards dollars and commodities. She started stockpiling commodities, which, put another way, is dumping dollars. So, and that has continued. And if you look literally from that time, commodity prices just literally turned higher. The laggard in all this is gold. Guess why? Why? Because and you'll know a lot more about this than me, so it's not me who should be talking about this, but it's bullion banks got themselves horribly short and have been trying ever since to get themselves onto some sort of square position at a time of accelerating monetary inflation. I mean, it's patently silly to be short of gold in these current times. But I have to say they have done an incredibly good job of managing expectations. It's very hard to find anyone who bought gold, let us say, in the last couple of years, who sort of sees the performance, compares it with Bitcoin and thinks, I'm in the wrong thing. So in terms of managing expectations, I must say the bullion banks have been very, very clever. But I think they have probably gone as far as they can go. And that was up to the expiry of the trading, if you like, of the April contract. The only thing which I don't know for certain is the liquidity in London. The last time I analysed it, I came to the conclusion that there was very little liquidity in London. I mean, the vaults have got, 9,000 tonnes, but that's all spoken for by ETFs, private ownership, and, possibly central banks. So the idea that there is a float there, a decent float which could be traded, I don't think it's true. What do you think about that? I mean, you can probably fill me in on that one, Andrew.
Well, no, I think that was actually, this is perfect segue, because I was going to talk about, I think one of the indicators of the backwardations, but also that's something that I think that would come right into your bailiwick. And so, but starting with that, now look, we often look at backwardations as they relate to gold and silver in the futures market versus what we see, of course, in the much larger physical or spot markets, as this kind of gives us at least some transparency into this smoke and mirrors world of the paper to physical imbalances that we just talked about. And it also gives us an idea of how to kind of trade it. But we're also witnessing backwardations that reflect exactly what you just said, a similar stress to March 2020 conditions, where we saw a $600 rally in gold and an $18 rally in silver. So, but backwardations also relate to interest rates and all the related crosses, and especially as the BIS appears to be telegraphing that negative interest rates will be the norm. What would be great if you could give everyone a larger view of what you see, especially as these relate to the pricing of all commodities.
I think to understand interest rates, you have to understand that there is a premium for actually possessing something. So if I actually have cash dollars in my hand, that is a premium to someone promising to give me cash dollars at some stage in the future. It's a bird in the hand is worth two in the bush sort of argument, but that's basically it. And then on top of that, there are other factors, obviously. You have got the rate of interest that the system offers, if you like. And on top of that, you've also got the counterparty risks and all these factors. And you end up with a sort of an omnibus figure in terms of, if I'm not prepared, if I'm prepared to lend you some money for, let us say, a year, what is the interest rate? Now, some of that is this time preference thing, the very fact that I don't possess it until a year's time. Now, this is important because what feeds into time preference is your and my view of what the currency that we're exchanging is likely to purchase in a year's time. Now, we have massive monetary inflation. We have a situation where the hedge funds in particular have begun to understand that not only are prices going to be higher next year and a lot more than 2%, but interest rates should also be higher to reflect the loss of purchasing power. You know, we're coming back to our calculation, if you like, which every borrower and lender has to make. Now, the fact that the central banks have been doing that calculation for us is immaterial. There comes a point where we think, this is not a good deal. The idea that I get 0% on my interest rates, or I have to pay 0.25% or 0.5% or whatever it is on my euros and Japanese yen and Swissies and Danish kroner. I mean, forget that. This is no longer the situation because the purchasing power of these currencies is going down. Now, that's the importance of the signal going back to 20th of March last year, when all commodities suddenly took off. And even something like Bitcoin, I mean, you know, up 700% or something, or 800%. I mean, it's just enormous. And the situation now is that is being reflected in bond yields out along the yield curve, because not only are we interested in, let us say, what we should be compensated for in terms of lending money, but also if we are lending money and we're taking a relatively risk-free attitude on this, it is because we have US Treasuries. So when we see the 10-year US Treasury rise, there can only be two things. The first explanation is that the economy is going to recover. Way, isn't this wonderful? The second is that the dollar is going to lose purchasing power, and people in the dollar are already demanding a higher return to hold those dollars. Yeah. So what we're going to see is not just 1.6, 1.7% yield on a synthetic 10-year Treasury. That's going to go way over 2%, 3%. And normally under these very, very inflationary circumstances, all fueled by monetary inflation, I mean, you know, where does it stop? It's going to be a lot higher. Now, the problem is that you've got on one hand the story that, well, rising interest rates is bad for gold. We've just demolished that story. But people believe it because they're fiat driven. Okay, so let's accept that. But the other story is that actually what we're going to see is an economy that's not going to perform. We're going to see massive inflation. We're going to see restricted production because the capacity isn't there. The purchasing power of the dollar is going to fall and fall and fall. Now, if the Fed decides to try and suppress interest rates, the speed at which the dollar falls will just speed up. Now, here's another thing. If you look at the total foreign ownership of dollars, financial assets in dollars, putting aside physical assets completely, plus bank deposits, it is in the order of $27 trillion. This is the foreign ownership of dollars and financial assets. So now we have a situation where, quite obviously, the Fed is not going to want to see interest rates rise, certainly not enough to compensate foreigners for their ownership of dollars. So what's going to happen to the dollar? It's going to go down through the floor. What does that mean for gold? Gold priced in dollars, even if gold stays steady, gold priced in dollars is going to rocket. I mean, it's the only thing that can happen. And interestingly, and this is something I'd be very interested in your views, Andrew, the canary in this sort of, if you like, monetary mine, I think it looks like being silver. We have had so much in recent days from, the sort of the Robin Hood guys suddenly latching onto SLV. And then we've had stories from Australia about how the Perth Mint, is sort of telling porky pies about what it actually has out there. And I think there's an outfit called ABC Bullion that seems to be running a fractional reserve system. I thought you needed a banking license to do that, for goodness sake, but, maybe not. So, and then I hear that there's similar problems in Canada with Kitco, and everybody in the silver business that I've spoken to or had emails from, it all indicates the same thing. There's no silver out there. None at all. I mean, virtually none at all. Except perhaps if you're a really big boy and you can sort of shuffle the stuff around with one of the other really big boys. But that's about it. Anyway, I'd be very interested in your view on silver.
Yeah, and I think that silver is definitely the Achilles heel of this paper scam. And I think this is why it is so interesting to see. And obviously we went through the Hunt brothers process. The big mistake the Hunt brothers made was borrowing their borrowing money margin from the casino, and then expecting them not to react when they started to accumulate all the chips. Well, obviously that is not the situation. I think right now we're seeing, and let's just face it. I mean, okay, it's in its infancy, but it's become a movement. And I think more and more people are catching on to this movement. And I think it's so interesting because silver is a very small market, as we know. And I think that if we get, there's 9.5, I think nearly 10 million of these Reddit raptors, as we call them. I mean, it doesn't take much for these guys, and they're all talking about physical all the time. It doesn't take much for these raptors to suddenly latch on and to start to continue to buy. And I think the thing is, we look at the wholesale market. We look at it and we go, yeah, we're involved in the wholesale market. Look, we look at wholesale. Hey, we're going to buy a 1,000-ounce bar. We only want to pay a few cents over, and that's what we're negotiating here. And we get involved in that whole discussion. Suddenly, you've got millions of potential people saying, well, hold on a minute. If I buy silver, if I buy a kilo bar, if I buy a coin, it's costing me $35-40. I mean, they don't look at the wholesale price anymore. That is the price. That is the price. And I think ultimately what you're seeing is this underground movement completely removing this sort of dislocating this paper game. And I think if it was going to start anywhere, it would start with the silver market. And in fact, that was really, I think that was one of the questions I was going to ask you. In fact, I asked every single person I've spoken to. I asked them, well, where would you position yourself right now? Would you position yourself personally? And I'm just talking personally here. I'm not saying we're giving trading advice. Would you position yourself personally overweighted in silver or gold at this time?
I would be overweighted in silver with a view to going back into gold, possibly at a later stage, because what we're looking at is the gold-silver ratio, in effect. Now, on a rising gold price, I would expect the gold-silver ratio to fall towards 40, maybe 30, depending, how far we're talking. So on that basis, you get more bang for your buck in silver than you do in gold. So I think, and again, I would emphasize I don't give investment advice, just as you have. I would have thought that something like 2/3 silver, 1/3 gold is a reasonable mix. But what I do, I think also it's worth making a distinction because, while we look at the prices day to day and we get tied up maybe with, this move, that move and all the rest of it, the vast majority of people who are following gold and silver are investors or traders. They are looking at it as something that they will take profits in eventually back into their accounting currency. Dollars, sterling, euros, whatever it might be. That is classic investment behavior. And that is what you're meant to do as an investor because you measure it against your base currency. But when we're talking about physical gold and silver, what we are, if you like, betting on is the possibility that the fiat money system will collapse. Now, this means that you do not take your profits in fiat currency. You will end up spending gold or silver. So with that in mind, I think that what you should look at as well is what are going to be the roles of gold and silver when the whole thing goes bang. Now, the central banks only own one non-fiat asset, and that is gold. And I have this argument with people about Bitcoin who think that Bitcoin is going to be the future. Central banks are not going to disappear the moment the currencies start going to the wall. What they will do is they will adapt their position so that they turn their currencies into gold substitutes. In other words, any central bank that wants to continue in existence will be forced to offer its citizens the option of converting paper currency into physical gold at the struck rate. Now, it's actually as simple as that. Now, when it comes to silver, you're not going to get quite that relationship because central banks don't have silver. They will concentrate on gold. They won't make the mistake, I think, of going back onto a silver standard because they lack it anyway. And nor will they make the mistake of trying to do too fixed a conversion rate between gold and silver. Isaac Newton set it at 15.5 times. And when I looked into it, I found it wasn't because he was a brilliant fellow, which he is or was. It was because that was sort of the prevailing rate at the time. So he said, OK, we'll strike it at that. And of course, there are times when demand for gold is greater than silver. And so they couldn't actually keep the peg running that way. And then it would go the other way and they couldn't keep the peg running the other way. So you don't have a fixed peg. But undoubtedly, there is a working monetary relationship between gold and silver, which will be set by the market. Now, that rate, I think, would probably, and I'm going to just assume this, probably be slightly more than 20 times. That being the case, then there is a hell of a lot of upside in silver because we're currently, 67 times? A figure like that. A lot of upside relative to gold. But I've been trying to get people to think in terms of you accumulate some gold now, hoard it. Let's use the basic language. Hoard gold and silver, which you will spend when the currencies actually fall apart. And depending how much you believe whether someone like me is actually talking sense or talking complete rubbish, that should adjust the amount of gold and silver that you hold relative to your assets against that time.
Sage advice, that is. Absolutely. No, that is really, really pragmatic view. And I think, ultimately that, obviously we always come at some point, well, what is the price of gold? Well, of course, the price of gold and silver. I mean, we could speculate all day long, but I think I just your thoughts on the way that I'm looking at this now. Obviously, we've got, and I've just, earlier in the interview, I talked about Basel III and 90-day window. I mean, really, this is a chance for the banks to unwind very large unallocated gold positions before an 85% haircut makes it way too expensive to engage in gold lending or hypothecation. And obviously, in anticipation of this new regulation, look, banks do not want to be short gold. We're quite sure of that. But when we value how the way we look at it, the way when I speak to our sovereign contacts, and these central banks value gold into this upcoming Basel III and then, of course, Basel IV deadlines, they want to address, I think it addresses a major imbalance, and that is gold's collateralization of US foreign obligations has reached historic lows. And under the covers, I actually think this is one of the objectives of Basel III and IV, and we're talking about protecting dollar hegemony, or an attempt to. And we see this, I think this is personally why I see this as the primary reason gold must be revalued when people say, yes, but they're the enemy of gold. But hang on, you have to start thinking differently here. The current ratio of gold to foreign debt outstanding is between 5 and 6%. No, look, historically, and you would know this, it's been 20 to 40%. That's the historical average. So really, I think that is where it has to be. Otherwise, the dollar is just going to be trashed. And so if you just happen to restore the age-old 20 to 40% ratio of gold to foreign debts outstanding, that puts gold at $6,000 to $12,000. And these are not pie in the sky numbers. And really, and we also think you talked about 1980s a little while ago, that was the last time the dollar was questioned. And actually, when we look at the numbers then, the actual collateralization was at 140%, which by 1980 levels, that would put gold at $43,000 right now. So I don't know. These are my thoughts, but these seem, people say, well, how can you be? Are you crazy? 12 grand? Well, why would it not be?
Yeah, I think there are two comments really. The first is, I think, a fairly obvious one, and that is the change in the relationships between gold, unallocated and allocated gold set out in Basel III, which I think I'm right in saying comes in at the end of June. I mean, what that's going to do is that's going to reduce the amount of synthetic gold. And I think this was confirmed by a letter or an analysis that the LBMA did, basically try to persuade the powers that be in Basel that this was not a good idea. So that I think is quite clear. Now, if you take away a lot of the paper out there, then obviously you're going to increase demand for the physical. It's as simple as that. And where's the supply coming from? Well, it's pretty fixed. I mean, I can't see that, you get a pickup in scrap on, $5,000-$10,000, but, there comes a point where that scrap starts dying out. And I think that that is a situation we're likely to see. The second point I would make is that a lot of the plans that are currently being knocked around, like, a new reset and all this sort of stuff, and new digital currencies, all depends on the central banks having time to introduce these new plans. Now, if you look at the overriding debt situation, which I very carefully analysed, the idea that the Eurozone banks, the corporate zombies, that the inflation problem with stock markets being crashed by rising US Treasury yields, all these factors are not going to happen in 3 years' time. They're going to happen in the coming months. So there isn't time for all these wonderful plans that people have to come about. Now, consequently, I think there's a very strong chance that we will wake up one morning and suddenly realize that the world has changed. Now, at that stage, you've either got gold and silver or you haven't. It's simple. It's going to be bid only in our traders' language. So, those are the two things I would say. I think first of all, the contraction of paper markets, I think, is an important point, and that is the point behind this Basel change. And the second point is that things are so fragile. Do not sit there idly expecting you've got loads of time to do this and that. And anyway, when something happens, it will give me the signal that this is what I should do. Forget it. We're going to wake up one morning and we're going to say, oh, and we've either got it or we haven't. It's as simple as that.
Alasdair, that is a wonderful place to end this wonderful conversation. And what I would ask is that please come back, because you know what? I mean, we've scratched the surface here, and and obviously we relate a lot of this to gold and the exit of perhaps dollar hegemony and all these other wonderful subjects. But you're right, and that is sage advice again. Don't delay. You have to. Don't wait for the accident to happen. It's already in motion, as you say, and it's inevitable. And I really would suggest that people even listen a couple of times to what you're talking about, because it actually makes a great deal of sense. You're attacking areas that people don't talk about. And actually, you get on Bloomberg, none of the guests there talk about this kind of stuff. In fact, they'd probably mute it very quickly if they did. So
we wouldn't get asked back.
It's wonderful to have you here, and perhaps if you would be so kind as another time to come back and we can continue this conversation.
Well, Andrew, I always enjoy talking to you, talking with you, knocking things about. So it would be very much my pleasure to do this again. And if we can educate people at the same time, I mean, what a bonus. That's really what we're here to try and do, in my view.
Absolutely. Well, thank you so much. And again, we'll look forward to you coming back to see us again.
I look forward to it too.
Well, there you have it, another fascinating episode of Live from the Vault. And I don't know about you, but if that doesn't make you feel like you need to accumulate just a little more gold and silver, I don't know what will. Again, I'm no financial advisor, no financial expert, but what a great call. Thank you so much to Andrew Maguire and our special guest, by community demand, Mr. Alasdair Macleod. We thank you. Now, be sure to help us spread the word about this channel by liking and sharing and subscribing. And if you click on that bell right there, you'll be notified as these episodes go live. Now, one more thing, in the comments below, make sure you tell us who you would like to have us interview regarding the physical precious metals market. We'll do our best to bring them on as we continue these series of powerful interviews. And with that, we will see you next time on Live from the Vault. See you then.
Don't get caught up.